Infrastructure is booming right now with an $18 trillion tailwind through 2040. In this video, we're going to discuss two leading CEFs, UTF and UTG, that offer 8% annual distributions paid out monthly that investors can use to gain exposure to this massive tailwind. Hey everyone, this is Samuel. I run High Yield Investor, the top-ranked investing group on Seeking Alpha, and I specialize in dividend investing. I recently launched my YouTube channel in order to share my unique approach to dividend investing with a larger audience, and I need your help to make it a success. So please like this video, subscribe to my channel, and share in the comments section below what you think about the infrastructure tailwind, as well as funds UTF, UTG, or any other of your favorite infrastructure investments right now. I'd be greatly appreciative. Thank you very much. So what is this massive $18 trillion tailwind that the infrastructure sector is enjoying right now? Well, it's been estimated that there will be an $18 trillion investment shortfall by 2040 in the infrastructure space due to the massive growth in demand for infrastructure assets. These are driven largely by five main trends. The first one is demographics. Many leading populations, especially in the larger economies, are aging rapidly, whether it be China, Japan, South Korea, the United States, Europe, Russia. They're all aging very rapidly, and this means that retirees are going to need fixed income investments, or at least investments that pay out high cash yields that are very stable in order to fund their retirements, because the government, social security, safety nets in these countries are not going to be able to handle the massive wave of retirees that are coming in. So as a result, assets like infrastructure that pay that really high, stable, reliable yield are going to become increasingly attractive. Another major tailwind is development. You have in developing nations rapid economic growth and even rapid population growth in some cases, and this is raising enormous need for new infrastructure to be developed in those countries. Meanwhile, in developed economies like the United States, you have a lot of infrastructure that has aged significantly, whether it be bridges, highways, airports, shipping ports, railroads, etc. There's so much need to replace and modernize a lot of this infrastructure. Another major tailwind is the digitization of the global economy. With the rapid adaptation and growth in the AI sector, as well as other areas of new technological innovation, there's a huge demand for new data centers and other infrastructure that goes along with that digitization of the economy. This provides an enormous opportunity for infrastructure investors to invest in these assets and make large returns and enjoy very strong growth profiles. Another major tailwind is the trend of deglobalization, where there's a reorientation and a reshoring, or at least nearshoring, of supply chains, especially in places like the United States and Europe, as they try to decouple and de-risk their economies from China as global tensions mount. This means that there is enormous construction going on of new infrastructure assets in and near the United States and Europe. It provides, again, infrastructure companies enormous opportunities to invest, especially in the areas like semiconductors and other strategic industries. The final trend is decarbonization, and this is potentially the biggest one of all, as the global energy supply chain is trying to move away from high carbon producing sources of energy to low or even no carbon producing sources of energy. Regardless of your thoughts on the politics of this, what your thoughts are in the energy space and what truly is better energy, or even your thoughts on if global warming is even a legitimate threat to begin with, the point here is simply that there is an enormous amount of money going into this sector, and so there's huge investment opportunity here for leading investors. As a result of these five major macro trends, it's not surprising at all to see the leading alternative and just generally asset managers in the world pouring money into it, whether it be BlackRock, Blackstone, Brookfield, or even Warren Buffett's Berkshire Hathaway. They're all pouring hundreds of billions of dollars into this space. And so there's going to be enormous investment, and as we saw the huge $18 trillion shortfall, there's nearly limitless opportunities for investors to pour additional capital into this space and reap strong returns as a result. So that's where UTF and UTG come into play. Both of them are well-diversified infrastructure closed-end funds that offer investors an opportunity to invest in this mega trend while also generating very attractive current yields of over 8% paid out monthly. Which one should you buy? Well, UTF is more diversified. It's more focused on the broader utility space, whereas UTG, which has utilities in its name, versus UTF, which has infrastructure in its name, they are kind of tells where they're focused. UTG is more focused on strictly the utilities side of infrastructure, whereas UTF is focused more on the broad panoply of infrastructure investments. Additionally, UTF is more diversified because it also has a meaningful percentage of its portfolio allocated to preferred equities and bonds, whereas UTG is almost entirely focused on common equity investments. While UTF perhaps has the diversification aspect going for it, UTG has several benefits. First of all, it has a lower management fee, so as a result, investors get to keep more of their returns from that fund than they do with UTF. Another major advantage of UTG is it has a stronger dividend growth track record of the fund itself, making it a potentially more attractive long-term dividend investment. Third, UTG also employs significantly less leverage than UTF does. And while this may mean that it gets less of an upside push during a bull market, it has much lower downside risk when the market crashes. Given that UTG already uses enough leverage to support its high yield and still provide a nice upward boost during bull markets, I prefer the lower leverage model of UTG because it provides much less downside risk in the event of a market crash, which could potentially permanently impair the valuations of both of these funds and even potentially lead to a dividend cut if the drawdown was sharp enough and forced a margin call. And I think UTG is better hedged against that, and so I prefer their lower leverage model. Finally, I also think that UTG has a more attractive price relative to its historical NAV right now, giving it a more attractive valuation. As a result, between these two, while I think both are very good funds, they have strong track records of paying out stable dividends even through the COVID-19 crash. They provide good diversification and a nice leveraged and actively managed exposure to the infrastructure space. And as a result, I think both will do fine for years to come. And I don't think there's anything wrong inherently with owning both if you're a CEF kind of investor. However, if you're focused on maximizing your risk reward, especially if you want to buy some individual stocks in the broader infrastructure space to provide better diversification, I think UTG is a better option than UTF right now. If you enjoyed this video and it benefited you in some way in your dividend investing journey, please give it a like, subscribe to my channel, and share in the comments below what you liked about the video, what could be done better, and what you would like to see covered in future videos, as well as what your thoughts are on UTF and UTG. Thank you very much. See you next time.